Hello again. We're delving now into Chapter 8, Reporting and Analyzing Receivables. In this chapter, we will focus on accounts receivable that result from day-to-day sales and notes receivable that may be issued for longer-term sales transactions. The objectives for the chapter, now on slide 3, are outlined on this slide. We will look at how receivables can be managed to get cash in the door faster in a business and how bad debts are accounted for, among other things. This chart provides a different look at what will be covered in this chapter regarding receivables. Note that there is a clear difference between accounts receivable and notes receivable, as we will examine further when we get into them. Now on slide 5, the common theme to all receivables is that they are assets that will result in the collection of cash, ultimately, unless the customer or other debtor fails to make payment when it's due. Note that other receivables are unique and not necessarily frequent transactions that involve non-revenue items such as loans to officers, advances to employees, taxes refundable, and so forth. So these are the three main groups that are shown on this slide, and we'll be dealing primarily with accounts receivable and notes receivable. On slide 6, you can see on this slide that receivables as a percentage of total assets in a company varies widely among major companies that are on the stock exchange. Think about, would this have something to do with the types of products involved, larger, more expensive versus smaller and cheaper, as well as the company's credit policies and philosophy toward extending credit. As you can see, a wide variation here. On slide 7, two accounting issues of recognizing accounts receivable and valuing accounts receivable. Recognition is important, as we discussed in an earlier chapter, because it determines the timing of when an asset and related revenue or expense and the related liability are recorded into the books. As we've discussed previously, in a service organization, a receivable and the related revenue is recognized when services are provided, regardless of when the service is billed to the customer or when the customer pays for it. And with merchandisers, we discussed the point of sale being when title passes from seller to buyer, based on the sales terms of FOB shipping point or FOB destination, as we discussed in an earlier chapter. On slide 8, note that when the sale is recorded, there is no recognition of the potential discount that's being offered because there's no evidence yet that the buyer plans to take advantage of that. So at this point, the sales amount is recognized in full. By now, you're hopefully familiar with the debit entry to accounts receivable and the credit to sales revenue to record a typical sales entry. On slide 9, remember from a previous chapter the use of the sales returns and allowances and sales discounts contra sales accounts that are normally debited, whereas sales has a credit balance. As we can see on this slide, there are two entries, one involving a sales return of merchandise by the buyer for $100, which results in a debit to the sales returns and allowances account, and a credit to accounts receivable. That is, sales and receivable amounts are both reduced. Then, payment is received from the customer within the discount period. So it's important to note that the cash received is less than the amount of the receivable still carried on the books, the $900 versus the $1,000 originally due to the return, and that the discount is computed only on the remaining balance of $900. So it's 2% of $900 or $18, and the net cash received is $900 minus 18 or $882. Important for you to get the salient points of what's being presented on this slide because it could show up in a quiz or exam question, much like this example here. On slide 10, you can see this vignette on page 400 of the text. In this case, the fraud occurred due primarily to lack of adequate segregation of duties. as we saw some cases of in a previous chapter. The previous chapter, in fact. In addition, there was a lack of adequate internal verification by the controller, who may have otherwise detected that something funny was going on long before the fraudster was caught. On slide 11, in valuing accounts receivable should be carried at their net realizable value. This means recognizing that some of the accounts will not be collected. That is, some customers will not be willing or able to pay. There should be an estimate based on experience, industry averages, and best judgment of what will not be collected from the current accounts receivable balance, and this estimate will be recorded as a bad debts expense. And we'll get to that a little bit more as to how that's done. On slide 12, there are two ways of addressing this issue of recognizing that some of our accounts receivable will ultimately not be collected. The first here, as it says on the slide, is theoretically undesirable, and that's the direct write-off method. And there are some reasons in the bullets there cited as to why it's not desirable. There's not necessarily a proper matching, the receivable not stated at net realizable value, and it's not acceptable for financial reporting. So using the direct write-off method, as noted on page 401 of the text, only those receivables individually determined as uncollectible from specific customers will be written off by a debit to bad debts expense and a credit to accounts receivable. This seems like a logical method, but it ignores the other potential accounts that may never be collected, besides the obvious ones the company has identified and written off. Therefore, the preferred method is the allowance method, in which an estimated uncollectible amount is determined for each period. This enables better matching of revenues and expenses than the direct write-off method normally would. The allowance for doubtful accounts is a contra asset account, similar to accumulated depreciation, in that it offsets a related asset account, in this case accounts receivable, and it has a credit balance and an associated expense or debit entry, in this case the bad debts expense. And you can see the allowance method is not only more desirable, it's required by GAAP or generally accepted accounting principles. On slide 13, they show the T accounts for accounts receivable and the allowance for doubtful accounts, beginning and ending balances here. You can see again the allowance account has a normal credit balance. On slide 14, now we can see how these accounts are presented in a balance sheet. Note again the similarity between accounts receivable, relationship-wise with the allowance account, and fixed assets and accumulated depreciation. The allowance account, again, is an offset to accounts receivable, so it's subtracted from accounts receivable to get the net realizable value of accounts receivable, which in this case is the $475 shown in red on the slide. On slide 15, accounts receivable can also simply be presented at its net realizable value with a brief description as shown. So this way just the $475 is presented, but it's explained that it's net of the $25 allowance for doubtful accounts. On the next slide, be prepared to hit the return several times to see other information filled into the T accounts and to see the script associated with that slide. And hopefully works the same way for you as it does for me here. So we're filling in that there was a sale of 100, there was a collection of 333, and as we go through, the journal entries are shown as well as the T accounts. So this 333 has a cash collection of 333, or a debit to cash, and a credit to accounts receivable of 333. Then there's in addition to the allowance account, via a debit to bad debt expense of 15 and a credit to allowance for doubtful accounts of 15, and that again is an estimate. So that's put in the allowance for doubtful accounts T account, of course, as a credit entry there. Then there is a write-off of uncollectible accounts for $10. And so notice what happens here is that the allowance for doubtful accounts is debited and the accounts receivable then is credited. And I know that at least some of you may have trouble with that concept. Well, why are we debiting the allowance for doubtful accounts when we actually write off someone's account? And I guess the best explanation that I can give on that is that we're recognizing a piece of the estimate that actually came true, and so we're adjusting or reducing the estimated amount by a real write-off. But instead of doing it as the direct write-off method did, which was a direct debit to bad debts expense and credit to accounts receivable, in this case we're debiting the allowance for doubtful accounts, which represents the estimated amount of uncollectibles, and we're crediting accounts receivable to write off that particular account. So when we finish filling these in here on the T account, you can see that the $10 write-off went as a credit to accounts receivable and a debit to allowance for doubtful accounts, as was discussed. So the thing to note in this slide is how accounts can still be written off when the allowance method is used. However, since the allowance presumably included all estimated write-offs for the period, when an actual write-off is taken because it's clear that the customer will not be able to pay, then the allowance account is debited to reduce it when the account receivable is credited. Key thing for you to understand. So if you do have any question, please bring it up via email to me or on the discussion board for the week. All right, moving to slide 24. Note that the ending $30 balance in the allowance account is what is shown in the asset section of the balance sheet, and that the $30 balance is the result of the beginning balance, the estimated addition for the current period, and then the $10 subtraction for the actual write-off. And on slide 25, the direct write-off debits bad debts expense while directly crediting the accounts receivable account. So here again, we're talking about a specific customer who we believe is not going to pay. On slide 26, this chart reviews what we've just been through regarding the use of an estimate for uncollectible accounts and how that estimate is debited to bad debts expense and credited to the allowance for doubtful accounts. Actual write-offs are then debited to the allowance account and credited to accounts receivable as they occur because the part of the estimate has become a reality. With that, we'll wrap up this portion of the presentation.